Everyone, my name is Tiffany Wang. I'm a partner at MS&AD Ventures. We're an early stage global fund backed by Mitsui Sumitomo and Aiwa Nisei Dowa. We have investments all over the world and very broad ranges: insurtech, fintech, mobility, digital health, impact. We like interesting data sets that touch insurance. Today I'll be talking to you and moderating a panel mapping out customer journeys for better customer experience. We have some really great entrepreneurs here today to share their journey. So can you guys just briefly introduce your name and
my name is John Swigert. I'm the co-founder and CEO of Pi Insurance. Pi is a small business-focused workers' compensation insurtech. We've been in business just over 5 years. And I'll share about our work on customer journey.
Rabia Lamadi, I am CRO and part of the founding team from Unqork. We are a SaaS company that specializes in providing the capability for insurance companies and financial service companies to build software based on visual configuration to drastically cut the time to develop software and the cost to develop software. And insurance is one of our biggest sectors, so looking forward to the discussion.
My name is Matt Merlebacher. I'm the co-founder and CEO of Fabric. We are a digital life insurance platform, and we offer parents a one-stop shop for family financial protection. So that includes fast and easy life insurance that you can get in a couple minutes on your phone. We also offer a free will, tools to organize your family's finances, savings accounts, and comp savings.
Thank you. So John, I have to say congratulations. I saw the news this morning. You just raised a massive, massive round.
Thank you very much. Yeah, it was challenging times to raise that kind of money, but we're super excited about what that's going to enable us to do to continue to push forward our business.
Yeah, for those who don't know, can you share how much you raised?
Yeah, so it was our Series D. We raised $315 million. That's going to allow us to capitalize the balance sheet of an insurance carrier, continue to push on distribution, and build out of our rating and pricing algorithms and workers' compensation, as well as expand into other lines of business. Just over doubles our total funding today.
That's wonderful. So let's talk about insurtechs. Insurtechs, maybe 5-6 years ago when they started to come out, they were mainly focused on digitizing the front end, right? But since then, I think insurtechs have evolved quite a bit. So I'd love to hear from the panelists, like, what are some of the things, the insurtechs 1.0 versus what they look like today?
I'm happy to start with this. So I think the big difference between the 1.0 and 2.0 is the 1.0 it was good enough to digitize the front end, create customer experience, fill the forms and everything. But then everything after that was manual. Basically everything from underwriting to servicing was pretty much manual. The 2.0 is the full-fledged, full life cycle of the product, all the way from prospecting to the application itself, but most importantly, all the backend, the back office, all the way to the underwriting, and then the ongoing servicing of the client. And it's not a one solution play too, it's also an ecosystem play. Not only bringing the technology, but bringing all the data vendors, the open architecture to make it one, a seamless experience for the client, and to bring a lot of efficiency to the operation of an insurance company. If you want to add.
Yeah, no, I'd say when we started back in late 2015, there wasn't a ton of technology that was off the shelf that could be used for a modern insurance journey. So we built a lot of that ourselves. We did the front end, but we also built our own underwriting workbench, underwriting engine, policy administration platform, all of it from kind of the ground up because we wanted to deliver a very specific kind of great customer experience. Now, I think there's a huge opportunity, though, for incumbents to digitize their workflows. It's still shocking to me that much of these flows are paper, so you're in the right spot. I would say beyond kind of just digitizing all of those processes, there are opportunities in distribution where I think you can build new software experiences, new software products, and tie them directly to insurance. And I'm sure we'll talk about embedded. But there's some really exciting opportunities there as well.
Yeah, I would add, so I agree with my co-panelist views. I think from the InsurTech 1.0, if we're going to use that term standpoint, it was very much about the customer experience. It was about, we want to make things easier. These old traditional insurance companies have trouble doing that and can't do it, and we can use and leverage modern technology and do it much faster and much better. What I would say is that's all true and that's all important. What was often missing, I believe, is leveraging your technology and your expertise to sort of, quote unquote, do the insurance better. The risk selection, the risk assessment, the pricing of the insurance policy, such that you can actually grow profitably in the market. And in insurance, growing profitably means growing at a loss ratio that's actually sustainable and actually going to work. I think that's the big difference, and there's a lot of differences, but I think that's the big difference that now, and this has always been our approach at Pi, there's a focus on growing because you are more granular in your risk assessment. You are identifying finer grains of differences across your customers, in our case, that's small businesses, so that you can match price to those risk elements better and still earn a loss ratio that works for you, works for your reinsurance partners, and delivers better value for the customer.
Great. Actually, I just want to see who's actually in the room. How many are insurtechs? Raise of hands. Okay. And then how about like corporates? It's about 50-50. VCs, investors? Small number. Who? Okay. Yeah. All right. So it's like about 50-50. Okay. So let's talk about reinsurance and interest rates. How, is that impacting the insurtechs nowadays? The interest rates going up?
Do we have any reinsurers in the room?
Reinsurers in the room?
We primarily sell term life insurance. Term life insurance isn't the most rate sensitive, so it doesn't impact those directly. However, what we are seeing is that for the financing of future revenue streams as MGAs, and we had been really a pure play MGA before we were purchased by Western and Southern, and now we're truly a full stack insurance company. But for MGAs who are looking to reduce the capital strain of acquiring customers and underwriting them, many will finance the future stream of revenue that they would get by for administering the business and for acquiring that business. With higher interest rates, that future stream of cash flows is much less valuable now, and so there's definitely more and more pressure on insurtechs and others who rely on that kind of financing to reduce that capital strain earlier. So I think the higher interest rates are going to have an impact that could be quite significant to insurtechs.
I would jump in. So we sell what's called a long-tailed line of business, means the liabilities take a long time to bear out. So it's somewhat interest rate sensitive. And historically, the insurance market, whether it's reinsurers or primary, have had a more balanced approach of earning money from underwriting results and earning money from investment income. In the historically low interest rates that we had, investment income was not as significant. So if we go back to something that looks like before, then frankly, combined ratios can actually rise a little bit because you have more earnings potential coming off of the investment portfolio. So it is possible that it actually introduces a little bit of a positive for reinsurance-dependent insurtechs, because the margin requirements from the reinsurers may go down. I'm not making a prediction, but it could happen.
Let's double click on some of the customer experience at Pi Insurance. Was there anything that you've learned over the years that seemed to make a very big difference for your customers?
Yes. One thing is, so we are multi-channel in how we approach the market. Prior to Pi, I worked at Esurance for 13 years. That was largely direct consumer personal auto insurance. Small business commercial insurance, we do sell directly, and it's an important piece of what we do, but it's much, much smaller. And so being able to actually serve the independent agency channel and deliver your product through the independent agency channel, simultaneously to being direct, we also work with payroll companies and partners, is important. And so that ability to touch customers in all of the channels that they might be in, because customers are not monolithic. They are not, I believed this when I was at Esurance, I believe it now. Not everything's going to go direct, right? There's a lot of customers that will continue to buy through agents. There still happens in every channel or every type of insurance. And so then what we saw these crossover effects, right? You see a customer might show up online because they want to look at your offering because they saw an advertisement or they were just doing a little bit of research. But they have an agent and they actually want that agent to transact for them. And so we see that quite often where we see direct customers and agency customers sort of going back and forth. And the key for a company that started out as we did is we approach the market that way from the beginning. And so while I won't say it eliminates channel conflict, it reduces the channel conflict because every agency partner that we have knows that we also sell direct. And we are very clear about how we do that. And we frankly prioritize the agents if there's any conflict. And it seems to work, where if you're a traditional company and you're only agency but you want to go direct, that's going to be a more challenging path.
Just to comment, I think what you said is exactly right. So Unqork, we're not obviously an insurance carrier or insurance broker. We power the technology behind insurance companies and brokerage, but definitely we see the trend for multi-channel, which is you can build a system for one channel. The system you have to build will be direct through basically distribution partners, and these distribution partners may have different data structure, data models, so the flexibility to go across channels is the big trend in the industry now, and you have to have it to be competitive in the market.
So being able to go across channels.
Yep.
Okay, great. The audience, if you guys have any questions, I have several questions, but if you have any, please use that QR code. I could pick some that's coming from the audience as well. Robbie, let's talk about the customer journey for B2B and commercial insurance. How has that evolved? And you've probably been behind a lot of this, especially for large carriers, right? Because a lot of your customers are these major carriers. How does your solution work? What has been changing for the customer experience for the segment?
Yeah, if you think of Insurance 1.0 and a lot of the InsurTechs, a lot of the focus was on consumer. Basically, consumer wants to buy an insurance policy, annuity, etc. The B2B space, where you basically have the big brokers, the big carriers, and the big institutional clients, that did not really evolve much, I would say, in the last few years, and it's still very bespoke in nature. And if you think of the parallel between that market and capital market, which is on the trading side. So currently, if you're a company, you want to do a hedging for your foreign exchange, you go to a broker dealer in financial services, all the transaction happens straight through processing. There's an exchange in the middle, everything happens, there's no paper. 30 years ago, it was all done on paper. That's the equivalent now of the insurance market, where it's still bespoke, but the last, I would say, 2-3 years, we saw a huge basically push to digitize the different life cycle of this market, which is the order entry, the placement system on the big insurance brokers are getting digitized. And we're doing a lot of work with that with some of the big brokers in the market. But then the pipe, the connectivity between the insurance brokers and the carriers, all the back and forth that typically happen through emails and PDF, also being digitized. My expectation the next 3 years, the market is going to be extremely different. Because one, currently with the current structure, one, is super expensive. Two, it basically takes a long time to basically issue a policy, and obviously not the best customer journey. So that market is going to evolve very quickly in the next few years, and tons of efficiency and tons of new products will come to market because of that evolution.
When you see the incumbents digitizing, and when they come to you as potential customers, do you see them doing it with a product that is a non-traditional product for them, or do you see them go with a traditional product?
We have a client that's doing it, and it's a huge insurance broker across the board, and globally too, by the way. You can't just, because a lot of these companies on the broker side, they have multinational clients. You cannot just do it in the US market. You have to do it globally to basically cover your clients globally. So we're seeing across the board. Obviously, you don't want to start in every product in the market. You want to start somewhere. But definitely the trend is across products. And obviously the highest volume one will be the one you start with.
With the highest volume one?
Because that's where you have the biggest impact in terms of cost and the returns on the business and the velocity. And the last thing too is, because of the current process, a lot of the data is not captured anywhere. Tons of unstructured data in PDFs. People pull maybe 10% of the data that you can pull. So eventually the data analytics you can build on top of these digital environments will be humongous in terms of the insights you can get from this data that currently nobody is using.
Thank you. Adam, let's talk a little bit about life insurance. How has this, that space evolved?
In the last few years, it's evolved pretty quickly, although I'm still surprised to see that the majority of policies that are issued are still kind of fully underwritten traditionally through medical exams. We have fully digitized that underwriting process so that someone can come in, answer a few questions. We will digitally underwrite them using a variety of data sources, give them an instant offer, and then they can electronically sign their application and then purchase it with a credit card. And it's all done in just a few minutes. The traditional process is usually it took me 10 weeks to get coverage. I had to meet with an agent multiple times. I had to go through the exam. I thought I was dying because I hadn't actually heard back about my exam results. So, there's a lot of room for improvement still in the life insurance industry, and it's not just about direct to consumer. It is about digitizing these processes, even in the agent-driven world. Nobody wants to wait as a consumer to get an approved offer or to go through a long underwriting process when you can otherwise do it with technology in just in a couple of minutes. So that's a lot of what we're seeing. I would say beyond that, though, I would expect that most incumbents are going to catch up to these digital processes. There are great off-the-shelf tools now that you can use and deploy. In order to have a really unique, differentiated offering, though, it is, in the direct-to-consumer world, going to be important to build digital experiences and journeys for your customers that are not just about life insurance. Most of you probably don't wake up in the morning thinking about life insurance. Consumers don't either. And so it's really important to think through, how can we meet the public, our audience, wherever they are in their financial security planning journey, and offer them products that they can use today, and you can build a relationship with them over time. And what we found with our digital products, many of which are free, like creating a will, like setting up a college savings account, these are ways that we can engage with these consumers. And we find that around 20% of our life insurance purchases are starting with these other free digital products. So it's a really important part of our go-to-market.
So nowadays, I think there's more and more MGAs and insurtechs that are being built. What do you think it takes to be a competitive insurtech today?
It can't just be about underwriting. It can't just be about great self-service. It can't be about any one part of the value chain. It is about going beyond just insurance and offering a differentiated digital experience that's supported by human help if you need it to guide you along that process. Those are the key pieces that you're going to need in order to break through.
From our perspective, we are the technology partner and a lot of the MGAs in the market. And the one thing that is different from the past is the cost of entry from a tech perspective. To build an amazing digital experience is the cost and the time to market is drastically different than the past. So you can literally launch this technology much quicker, and you can very quickly iterate your customer journey based on what you get from the market in terms of reaction. So the technology itself is much more affordable and much more reachable, and that we see across the market now with the MGAs.
I'd have a slightly different perspective. So I'm going to speak specifically about insurtechs that are manufacturing an insurance product as opposed to a software or SaaS company or something of that nature. Fundamentally, this is a risk business that we do not know the cost of goods sold when we sell the product. And 50 to 70% of our cost, if you look at the sort of the full scope of the premium dollar, is going out in, depending on the line of business, is going out in claims and loss adjustment expenses. And so I believe all of the things that my co-panelists said are true and accurate and right. I just happen to believe, and I think we believe at Pi, that you have to be better at risk assessment and risk pricing than others if you're going to win long term. I think that's been demonstrated by companies like Progressive, Capital One and credit cards, that the more fine, granular risk assessment is the first most important thing, and then building in an easy distribution process, a multi-channel distribution process, a great customer experience, a great claim experience, and so forth. But if just fundamentally you have to deploy your technology at being better at picking out risk than other people.
And what do you think those criteria are?
It totally depends on the line of business and the customer set. Yeah. I mean, that's probably an unsatisfying answer.
Yeah.
But,
do you want to go a little deeper? Choose one line.
Yeah, no. Well, I'll choose workers' compensation, right? So right now, we don't actually. The primary drivers of our rating algorithms are similar factors and characteristics that most of the market uses. We just put them together in a different way, in a much more refined way, and look at the interactions between the variables. Because today, since we work with distribution partners, they're not necessarily collecting the unique and different information that we would need because they're shopping sort of the market overall. Over time, as we build out our overall data collection and data ingestion abilities, and we can merge that with the accumulation of claim and premium history that we have, then we can identify those unique pricing opportunities and underwriting opportunities that really are differentiated. So today, we just sort of take the same ingredients and make a better, recipe. In the future, it's more about having ingredients that really are unique. So.
Thank you. Much more satisfying.
Yeah.
Let's talk about embedded. Everyone's talking about embedded. Everyone's saying they're doing it. Maybe they are, maybe they're not. What's your definition of embedded, and who do you think is actually doing it well?
I think it really depends on what you're referring to as embedded. When you have intermediaries who are offering products through embedded channels who are brokers, I think it becomes really challenging to get the economics to work because you're kind of an intermediary of an intermediary, and you really do need to, in those cases, own the risk in order to make the economics work. I think the other challenge to those kinds of models where you're working through multiple intermediaries is you don't actually control the customer. Like if you're embedding as an MGA your insurance in a fintech app, you don't own that end consumer, and so it's really hard for you to build lifetime value if you don't own that customer, and you can't continue to cross-sell and upsell. So I think that's a challenge. And it's hard to scale as well because you have to go through partners in order to scale. So you need a huge volume of partners, and you need some really large partners as well in those cases. I think that the best case for embedded is where you actually own that channel. Like you own the channel like a Tesla owns its channel and can then embed insurance. That is a great model. The coalition model is a really interesting model where they are offering software services for security, but then they're also offering the cyber insurance in the background. So I think those kinds of models have sort of an unfair advantage over the ones that are kind of the intermediary of an intermediary model.
From my experience, I see this a lot with our wealth management clients, with the retail wealth, private banking clients. There's a big push by all these clients or companies to go and push insurance products in the market. And they have done it before. It's not new, but it was all manual, which is very expensive. You have to hire advisors. But now with the digital capabilities, we have a number of clients who are building marketplaces or have built marketplaces in Unqork to push distribution, push annuity products, life products to their wealth management banking clients. And it's a lucrative segment for them, and it's low touch because they don't want to have a lot of manpower on this. And they're offering clients a lot of different insurance products. So we see there's a big trend in wealth management.
So I think the concept of embedded can be pretty broad and diverse in what you think of something as embedded. I agree very much with the points that were made, and I would add that for something to be
meaningfully embedded, right? So to your point about just an intermediary of an intermediary of an intermediary, it's going to be pretty obvious. Are you delivering real value to the end consumer, the end user, through the integration of this product that didn't exist before? And if you are, it's going to be obvious. The uptake is going to be the connection rate, the integration rate, whatever you want to call it, is going to be high, and it's going to be meaningful and value additive. You're going to drive down acquisition costs. You're going to increase data collection abilities, things of that nature. It's going to be a win-win-win, right, for the two partners and the customer. That is sort of the holy grail of embedded. There are lots of examples of where those exist. In our particular market, we find it exists in a payroll channel, right? So payroll companies, workers' compensation insurance, those two things are very connected because payroll is the exposure base for workers' compensation. And you literally can create a better overall experience. We benefit as the insurer, customer benefits as a better experience, opportunity to lower the price overall, and the payroll company benefits by being able to deepen the relationship that they have with their customers, right? So there are lots of other examples, and there's also probably more examples of sort of poorly conceived embedded attempts, right? Where it really is just, oh, I have a lot of customers, let me try and add on 16 different things that are not relevant to that customer, and what you find is very little adoption.
Yeah, very good points. So what are you most excited when it comes to the future of insurance?
Yeah, I'm excited for more digital products that where you can lead with that digital product and then bring insurance in to complement it. So trying to find the complements between new software services where you can then embed in an insurance product. I think that's an exciting area to explore.
I would say in the insurance industry, the digital journey is still at its early stages. Despite all the great things that happened in the last few years, the potential of this business when it becomes fully digitized or much more digitized next year is going to create some amazing value for the insurance business, the consumer, the brokers, and it's an ecosystem play. Basically, is whoever can build an ecosystem of all the different technologies in the market, whether data providers, software providers, platform providers, put them all in a way that's going to make a big value, would create some amazing value in the market in the insurance industry in the next few years.
I would say, it's sort of an extreme example. I'm excited about making the insurance market smaller from a premium basis, right? So what I mean by that is insurance is about sharing of risk among a group of people, paying some small dollar amount in hopes of, if you have an accident, you get a large dollar amount, whether it's life insurance, right? Where you pay your premium, and if you happen to die before your term, you get a large payment, workers' compensation insurance and so forth. Most people in property and casualty insurance aren't using the insurance. They don't actually have accidents. And so the cost of insurance is effectively a tax. It's effectively the margin that we make as insurance companies, the expenses that we actually have and so forth. That's a cost element that group is bearing. And we want to drive that down. We want to get more refined at how we identify risk. We want to get more efficient at how we deliver our products and how we acquire our customers, so we can drive that cost down and deliver more value back to customers. And as I said, an extreme example, that would actually make the insurance market get smaller. I don't know if that actually happens because risks go up in the world and so forth, but having people pay less for the sort of the service we are providing is only going to be a good thing. It's good for them, and it's good to sort of grow the overall economy.
Yeah, that's great. And I actually really like preventative care, right? Yeah. Whatever that means, depending on the insurance sector. We have a really big, packed house. So who should come to you after from the audience? Are you looking for anyone?
Old friends.
Old friends, yeah.
Old friends.
Everyone, yeah, absolutely.
No new ones?
No,
anybody who's looking for small business workers' compensation insurance, come to me. We got some other pioneers. There we go.
And we provide technology and stuff
like
that.
Yeah.
Okay, great.
Do you have any questions from the
Let's see. No questions from the audience? No questions. No?
Oh, maybe one over here.
underwriting process is as effective as a traditional medical exam.
Yeah.
So let me just, or can you repeat the question? Go ahead.
How did we get comfortable with our digital underwriting process being as good as a fluid-based physical exam? So we worked very closely with our reinsurer, which had that history, and we ran sort of a regression on it. And it's not only that it's just about as good. You get a little bit of mortality slippage from a digital model, but the top of your funnel and sort of the middle and end of your funnel benefits from having more healthy people complete the process. Because what you have in a physical exam world is you tend to have adverse selection. People who really need life insurance will actually go through that full process, whereas those who may not need it as much, they may drop out of the process if you put roadblocks there. So you end up with a healthier pool at the end of things in a digital world versus a physical world. The other thing is we're actually able to price the risk at the same rates as if you had a health exam. You know, the prior generation of underwriting allowed for what they called simplified issue products, where they use just a little bit of data, maybe one or two sources, in order to underwrite you. They tended to be very expensive policies and also low dollar amount. You know, we will go up to 1.5 million in coverage with a fully digital process, and we do it at the same price as a physical exam would give you. So.
Sorry, can you speak up a little bit more?
Yes, so some of these digital processes that you're using for a while, but still there is the man's share of the market is still following the older processes. So what do you think is the alternative? Why aren't we seeing more market share in fire insurance, let's say digitally? Is there an education problem, or is there some sort of stickiness that we see there?
You can repeat it.
So I think the question, it was hard to hear up here with the fans. I think the question is, why is so much of the process in insurance still old, right? Why is it like still doing that? I think there's a lot of answers to that question and a lot of reasons. Again, not everything's going to go direct. Not everybody wants to buy the insurance themselves, even though more people do every year. We sell a lot of our insurance through agents, and sometimes they just like to email us, right? It's frankly, you know, a challenging behavior to change, but there's so much commercial insurance that just goes around via email, right? Adam, we mentioned this, like, it's like email a PDF or something and expect us to do something with it, right? Instead of, you know, entering the information in the manner in which, you know, we want them to. So there's a little bit of learned behavior, a little bit of history and sort of challenge. And if we just continue to push to make it easier, it has to be easier for them to interact in a more digital way with us than just to email and push it to us, right? So if we can create that, then that emailing interaction would drastically reduce, I would say.
And I would add to this also, still a lot of legacy technology. So, which makes it really hard to go and digitize the process. And when you digitize it with the old school technology or through traditional coding, it becomes super expensive and very expensive to maintain and change. That's one of the reasons too, where you see a lot of still things done on emails. But with the new technologies like Unqork, this is where you can really accelerate the process, make it drastically different, and make it much cheaper to digitize.
Okay, great. I think that's all the time we have today. Thank you all for coming.
All right.